If you had $100 in your hand, your $100 is the most valuable $100 you're going to have for a very long period of time. And what I mean by a very long period of time, forever. This is your most valuable $100 because over time, this 100 becomes worth less and less because of inflation. How many of you have filled up your car lately? I just filled up my truck, $63. And I remember, man, that's more than it used to. It is because gas went up. Okay. How many of you went to the grocery store and you just noticed that the same dollars you used to spend a week now only get you a lot less bags now? So what is that? That just means that the goods went up in price. No, everybody wants to think that the goods went up in price. That's not what happened. Your dollars became worth less when they printed 5 trillion or whatever they're at, $5 trillion. It's called inflation. And inflation is something the government wants. You all think, oh, the government doesn't want inflation. Sure they do. The government is severely in debt. They want to pay back that debt with weaker dollars, not more expensive dollars. They want the dollars to be weaker to pay that debt down with weaker dollars later. See what I'm saying? Not only that, the government is very, very, very scared of something called deflation. Study that. Inflation is not the problem for the government. Deflation is. The reason they printed 1.9 trillion is they want to curb deflation. And by printing money, they create inflation, which is what they want. But what they're going to realize soon, and what every economist knows, and I think what the government knows, because they're smart people, is they're going to lose. But they can kick the can a little further because they're playing the political game, and they are. And that further, we're way past that. So folks, don't be tricked by what's going on. Don't be tricked by this thing like inflation and, oh my God, my dollars are going to be worth nothing. Because the big thing that we all need to worry about is deflation. And that's probably what we're going to see in the next couple of years.
You're seeing it in the news, but what is it that you need to prepare for? Stephen, what is going on with the rate increases? What are the areas you think that's going to hit the most?
Yeah, I mean, and a lot been going on the last, week or two with rates and mortgage rates are increasing and bank rates are increasing and everything's kind of following, as the Fed increases rates overall, the bank lending rates. So it's going to start affecting, everything. We're already seeing that. So housing, obviously is going to be the most, kind of in the public view of everything. But behind the scenes, there's a lot going on as well with overnight lending and what the banks are doing and tighten restrictions. And all of that feeds into the flow of money. I mean, one of the reasons we've seen such prosperous stock market and just everything, prices rising on everything and the investment markets and everything over the last couple of years is because money has basically been free. I mean, it's been flowing, it's been printed, it's been spent, it's been given out, it's been thrown around in the trillions. I mean, so, all of that has just inflated everything, but that can't go on. We're seeing that because what's inflation doing? Just a couple of weeks ago, we had another 40-year high in inflation. And when you look at the wholesale inflation rate, the producer inflation rate, not the consumer, but the producer, which, is what drives the cost of goods, that's even much higher. So that tells us that, core inflation and consumer inflation is going to continue to rise, at least for the near future. So it's one of those things where it's all connected and it's all happening. So we need to be very careful what we're doing right now. And like you said, not fall into those traps. Yesterday is one of those traps where, last week there was a lot of short selling done by the hedge funds. A lot of that stuff drove the market to, like you said, the worst week in the last couple of years. And then, yesterday we see that bounce and that's exactly what it is they're trying to sell off to get themselves. And that kind of raises prices. People are like, oh, it's time to get back in. We hit the bottom, but no. I mean, we just opened up right now this morning. Dow is down, over 400, the futures. It opened about 350 down and it's starting to fluctuate a little right now. So we'll see, but just don't fall into those traps.
That increase signifies where we're going in the future right there. Powell tells Congress the Fed is strongly committed. I want you to really look behind the curtains on that one.
This just came out 5 minutes ago, Chris, just so you know.
5 minutes ago, Powell tells Congress the Fed, okay, and the Fed and the U.S. government are different. You know that, right? The Fed is its own thing. Read Creature from Jekyll Island. You'll understand it. The Fed is strongly committed to bringing inflation down. So in other words, let me dictate that and explain that in a fifth grade level. The Fed will do anything that it requires to bring inflation down. Now, that's the frontline story. That means they will crash the economy. Mark my word, that's what they're going to do, which means they will crash the stock market, which the stock market will go before the economy goes. But you're already seeing weaknesses, layoffs. You're seeing companies reporting future projections that are lower than they are today, expectations. But Stephen, what else is in here that's important to talk about? I mean, inflation is running too hot. Duh. What else do we got?
I mean, their immediate goal, they keep saying they want to get it down to 2%. I mean, whew.
So does everybody understand that? They want to bring inflation down to 2%. We're sitting about 8.5, 8.6. The new CPI numbers haven't come out in the core CPI, but they want to bring it to 2. So what you got to ask yourself is, if we're going to go from 8.5 to 2, what's that require? I don't really know. We just got done out in Palm Beach. Stephen and I and a couple of our other team members were out there listening to an economist, and he said it's going to take 6. It's going to take 6. Okay. That means the Fed is going to have to raise interest rates. That's Fed fund rates, not your 30-year mortgage rates. Fed fund rates to 6. That's what he was saying. All I can tell you is if they raise the Fed funds rate to 6, it's game over. But it'll be game over if they raise it to 3. It'll be game over if they raise it to 3.5. Me and Steven, I think we talked at that meeting. We think the number's more like 3.5. But the economist said they're thinking maybe 6. It is game over.
The problem, Chris, is they're trying to play so much catch up right now. Like just 6 months ago, they were telling it's all transitory. It's nothing to worry about. There's no problem. Every one of us saw what was happening and understood that, what was going on, but for some reason they just wanted, and so now they're saying, oh yeah, now we got to tighten and it's very important to us and all this. It's like, well, where were you when it counted? Where were you before, all this? Why weren't you doing this a year ago? Like, it's so frustrating,
It really is. And it's interesting. On TikTok, Tick Trend said crash. What do you mean? It's already crashing. And he's absolutely correct. He or she's absolutely correct. Down here, Grammy Elizabeth, I love this one. It's Jimmy Carter 2.0. Like, I mean, come on. It was probably pretty darn accurate right there. The Fed waited too long. Yellen coming on saying, oh, this is transitory. It's just going to pass. There was so much going on because, hey, listen, when you're drinking the Kool-Aid and the economy's running hot and you're getting unemployment back from the pandemic, everything, they're just pushing that needle, right? They're pushing it. It's like a car engine. You're running it at a red line. And then all of a sudden you're like, whoa, we overshot. And they didn't act fast enough. They kept the rates too low. They kept the easy money too easy for too long. Japan did the same thing and they never came out of it. I hope the United States can. This is a strong economy, one of the greatest economies in the world. So I'm confident and optimistic thinking it can, but the Fed acted too late. So now the Fed has to take drastic measures, just like he showed right there in that article, and they will. And those drastic measures don't just mean they're going to raise interest rates a lot. I wouldn't be surprised if July, they don't raise interest rates another 0.75 of a point. And that's going to be catastrophic.
When you make a deposit in your bank or you go online and you search for the highest interest rate, a high yield savings account, and you find one, many of you would have landed at Ally Bank, right? And you find that high interest rate savings. You're like, oh my gosh, they're paying 1.4%. Woohoo! Because my bank's paying me nothing. I can get 1.4 there. You feel good about it. You instantly transfer your money over to that new account. Well, there still lies a big problem there. Now, it feels good that you do that because that's what you've been taught to do, to seek the highest interest rate, but we're missing a very important thing. And that important thing is this. Do we all understand what inflation is? So let's talk about inflation. Inflation is nothing more than a hidden tax. I talk about this all the time. Some of you are probably sick of hearing about this and hearing me talk about this, but talk about inflation. So inflation is nothing more than how much your money decreases in value every year. It's the simplest way. It's a hidden tax. So a lot of people think inflation means everything that we buy goes up in cost. Absolutely incorrect. It is not that everything we buy goes up in cost. It is your dollars have less buying power. So your dollars are going down in buying power. So the goods stay the same, but it takes more dollars to buy those goods, which is why Brent and I always say your dollars are worth the most today, and we are taught to give up our good dollars. That's what we're taught to do. We're taught to give up our good dollars, give them to somebody else that's much better suited to handle our money, because somehow we've been taught that we're not capable of handling our own money. Here's your sign. Money problem. We're not capable of handling our own money. So what do? We give up our money. We find these high interest rate bank accounts. We find these CDs. Well, what does that mean? Do we all understand what inflation actually is and how much it is? Well, I did the research last night.
we went onto a whole bunch of sites, from the CPI to government sites, and we landed at this one, and I think it was inflation something. I have it written down somewhere. And inflation, the average inflation rate. Does anyone want to take a guess right now before I actually tell you what it is? What is the average inflation rate in this country right now? Does anyone want to take a quick stab at that one? Wow, that's really close, Natalie. 3.5. I was surprised when I saw it too. I really was. 4.2, 3.9. Okay, so you're all doing pretty good. So the average inflation rate netted, so there's a couple things removed from this number. I want to be clear. When you 4%, when you look at the inflation rate, not all inflation rates are the same. Okay, this is removed, like many inflations. The one I'm going to talk to you about has energy removed from it and also has food removed from it. So if you take energy and food out, what is the average inflation rate in this country? 3.2%. So now, we just put our money in that really great high interest rate savings account that we found, that Ally Bank, the highest interest rate one we could find out there that will pay a variable interest rate on our money. We put our money over there and we're like, yes, beat you. Bank number one that was paying me nothing, screw you, I'm making 1.4. No, you're not. You leave that money there for a year. Do you know how much you made? How much did you make? Well, I'll tell you how much you made. You lost 1.8%, 130%. Okay, that's how much you lost, because you're losing 3.2 to inflation. And I love that you guys were all higher than what the actual number was that I saw. So there, Chris said 3% is the official posted rate. Again, there's lots of official posted rates. That's what I found out. 3.2 was the most consistent average that I found across the board, very close to what Chris just said at 3%. So if you're losing buying power at a rate of 3.2%, which is a hidden tax, just so everybody knows, inflation, just another way they're stealing your money. Listen, don't get mad at me for saying that. That's what it is. Read the book, Creature from Jekyll Island. It'll tell you all about it. So if you're losing 1.8%, but you think you're making 1.4, what gives? What gives is, here's your sign. We got a money problem. And that money problem is nothing more than we need to understand that our money needs to be moving. Okay, so the only person that posted something on here that would even keep pace with inflation, not including food, not including energy. I want to be clear, 3.2 does not include the increase in food, and it does not include energy. Those are discounted out of that. So it's actually much higher. Some economists say that inflation is actually more like 7%. Does anyone think inflation is going to go up or go down? Well, I'm just going to tell you it's going to go up. They just printed, what are they up to now? $3.3 trillion that they just printed. That $3.3 trillion that they just printed has to get its value from somewhere. You remember, I tell this all the time. Remember Fort Knox? You guys, some of you, remember Fort Knox. Some of you are too young to even know what the hell Fort Knox is. You hear about it, but Fort Knox used to be this big vault where they held gold, which backed our currency. So our currency used to be valued and have gold as almost a collateral asset behind it. Well, the leprechauns figured that rainbow out right over to Fort Knox, and they stole all the damn gold. So now our money is literally valued at whatever the government says it's valued at. And when they print $3.3 trillion, that $3.3 trillion needs to get its value from somewhere. It's not just a bunch of numbers on a screen. Well, I'm sorry, it actually is, but it has to get value somewhere, and it steals that value from your money. But see, right now, what you're not seeing is you're not seeing the impact of that. You'd have to go back to the 1980s to really understand what hyperinflation means and why it happened back then, and then kind of go back. See, the history can teach us a lot about money, inflation, and all these things, but we have to study history to understand what's coming next. And what's coming next is just what Natalie said. They absolutely have to go up. Inflation is going to go up. But even if it stays at 3.2 and you're making 1.4, you're losing 1.8%, or 130% is essentially the number that you're losing more. That's how much more you're losing. Okay. That's how much more you're paying than what you're earning. 130%. So somebody else had a CD. Now a CD is a long-term instrument. Now you have to assume that the CD isn't taxed, which are CDs taxed or are they not taxed? As long as they're not in an IRA, they are taxed. So you have to take the tax away from the earnings that you get on a CD. So if your CD, which 2.5% is a great rate right now on CDs. If you're earning 2.5% on a CD, you're actually still losing 70 basis points, which is, what is that, about 80 and change percent more than what that's how it works. If you just do the percentage on it, you'll see how big the number is. Because, you know, when I say 70 basis points, that doesn't seem like a lot, but it's actually like 80% more than what you're actually earning on your money. That's right. So you see, when I say these things, we have to understand the sign. Here's your sign.
The Federal Reserve was created in 1913. Okay. What else was created in 1913? Go. What else was created? Okay. Cindy said income tax, federal. What else? Income tax, the tax code. Right. So that was the right. Oh, holy smokes. Just got crazy on me. The tax code. So it's kind of convenient that they created the tax code and the Federal Reserve right around the same time. And then look what happened after that. See, none of you remember this time frame because none of us were alive. Yeah, that'd be impossible, right? 19. Yeah, you weren't alive. But let's look at $100 and what the impact was. So in 1913, at the creation of the Federal Reserve, $100 was actually worth $100. Then as we go down, 10-year increments, 1923, $100 was now worth $57.89. Here, I want to share my screen and I want to show you something here. Okay, I want to show you something that'll give you a good visual outside of what I'm showing you right now. So here is what happened. Federal Reserve was created and look at that. Boom. Whoa. What happened? Well, a lot happened during that period, but we're not going to spend any time. Then that came back up. So in 1933, your $100 would now be worth $76.15. You're like, oh, sweet. You know, it went down to 50 and now it's back up to 70. All right, we're moving in the right direction. But then we get to 1943. Which was immediately, well, it was during the Great Depression, but just following the big ass fallout, the dollar started falling again. Okay, so in 1933, it was 76, and that was during the Depression. 1943, it was 57. See what's happening here, 43. We went from here to here, Great Depression. Okay, Bretton Woods Agreement, which, you know, many of you know what that is, some of you don't, not important, but 1953, it went down to 37. So 53. And then we had this long kind of period here where from 53, it was 37, 63, it was 32, 73, it was 22. All right, now hold on a second. During this period of time, we had the oil crisis. We had the second oil crisis, okay? If you remember, any of you that were alive in the 70s, there were lines miles long at gas stations because they were running out of gas. It was the oil crisis. Then we had the dot-com bubble. Then we had the biggest collapse, you know, the 2008. I want you to remember what happened back in the 80s, okay? Because this is an important thing. I want you to do a little history lesson, and I want you to remember what happened from 1973, and we'll just take it to 1993. Remember a little bit of a problem with inflation back then too? Remember, you could buy a house, but your interest rate would have been 10, 13%. Anyone? How many of you remember that? Is anyone here old enough to remember the 70s and early 80s and even into the late 80s? Does anyone remember that?
Yeah, my dad was saying he bought houses in the 80s at 18%, 22% interest rates.
And you could put money in a savings account and get 15%. You could put CDs in and get probably 16, 17%. Okay, so we got some people that remember this stuff. What drove those interest rates so high during that period? Inflation. Exactly what we're talking about today is exactly the reason that those things were that expensive. But it was just business as usual back then because that was the period of time you were in. But during that time, it didn't feel real good. Okay. There was a lot of problems back in the 70s with the economy, with the markets. It was a mess, but there was a lot of good stuff. So remember, in every down period of time, there's a lot of good that comes out of them too. A reset is not a bad thing. If you actually followed Austrian economics, it's just where they would just allow the markets to rise and fall at their own will. It's the healthiest kind of economy or economic strategy you can be in. But now we've evolved through that Keynesian economics, and now we're in modern monetary theory, where what the government does is just turns the printing press on, literally prints money and prints money and prints money and prints money, and puts little fancy buzzwords like infrastructure stimulus or whatever they call this thing on these different things. But all of this extra money printing will undoubtedly create inflation. It has to. Now, they're doing a pretty good job of kind of keeping that under wraps because they're not including housing, they're not including food, they're not including oil. So if you don't include all these things, it's pretty easy to say, well, it's only 4%. But at the pump, in the grocery store, out there in the world, it doesn't quite seem like it's 4%. It seems like a lot more. and it's going to get a lot worse before it gets better. So what our job today, Stephen and I, to do is to show you how in 1913, your 100 was worth 100, but yet in 2019, it was worth $3.87. So literally, you took this $100 in that amount of time and you turned it into that little sliver of your $100. Magically, with a hidden tax. So where did all that money go? Back to the source. Back to the source. Okay, it's always where it goes. You know this. The government creates inflation. It all goes back. The government wants inflation. Make no two ways about it. The government might say, oh, we're trying to curb inflation, you know, this and that. The government wants inflation. So it's safe to say that you all realize, yeah, all right, great. You all realize that your dollars are worth the most today, correct? So if they're worth the most today, we need to protect those dollars, and we need to make sure that those dollars don't ever have to, you know, lose to this inflation. And it's a tricky game. So, you know, there's a lot of people that talk about the solutions to inflation. So how do we actually play the game and beat inflation? So that's what the topic's going to be. It's how do we tactically beat inflation? So I'm going to throw up a whole bunch of things here. And what we're going to do is Stephen and I are going to talk about each one of these things as I put them up. And we're going to move the camera around just so you can get different angles. But see, I wrote them all down. I did my homework. You see, I got kind of mad and I crumpled it up and threw it out. And then I went back and I was literally having a difficult time figuring out how do you beat inflation, but yet prepare for deflation. And I finally kind of had that realization that you don't, but you can if you do X, Y, and Z. So that's what we're going to talk about. So first thing, I'm just going to hit it with the easiest thing that everybody already knows. Number one way to hedge, okay, inflation is gold. All right, so that is a hedge. I want you to understand this is not beating inflation. All you're doing is hedging against it. Because as the price of the dollar goes down, what happens to the price of gold? Typically, it goes up. But see, here's where you're going to have a hard time with gold. So I'm not saying run out and buy gold. James Rickard would, okay, but he would probably even say right now it's a bit pricey. And the reason for that is we're already kind of past the curve. Everybody realizes that we're in an inflationary period right now. So they've piled money into gold. Big institutions, big hedge funds, pension plans have bulked up on their gold positions to hedge against this. So by you getting in the game of gold right now, you're kind of coming in late, but you still might be able to capture some of that. So gold is a good hedge because the price of gold in an inflationary period when the dollar becomes worth less goes up. But what are the problems with tangible physical gold? Where do you put it, right? You go and you buy gold. Like number one problem is where do you actually store it? So I'm just going to put storage, okay? Because it is a tangible metal. You got to hang on to it. Secondarily, storage is a problem, but also how do you exchange it? You know, we don't live back in the ancient Roman times or any of those periods where literally we had gold coins, which you can get today. But I mean, do we just cut slivers off of the gold bars and exchange them? I hate to say, I mean, maybe someday we'll get there, but no time soon. So we got to figure out, like, how do we exchange it? Number three, liquidity. So it's not the most liquid investment, although it can be because you can easily exchange it to somebody else, but at what price, right? If you buy it today, are you going to exchange it or sell it at a higher price or a lower price? That's a tough one because it's high. All right, so some of these are the problems of gold, but just wanted to put it out there. Gold is a good hedge against inflation. This is kind of common knowledge. I think you guys all knew that. So you're like, wow, you're going to teach me something I don't know? Well, yeah, we're definitely going to. But number two, commodities. Commodities are, I mean, there's a lot of things. They're precious metal, they're beef, they're grains, they're oil, they're like utility companies or electricity. They're things like natural gas. Those are commodities. And the cool thing about commodities is I want you to think about inflation. You're seeing it right now. All of you are seeing this as we speak. Inflation goes up. What else? When the dollar gets weaker, what happens? The price of things go up, doesn't it? You're seeing it. So what price of what things goes up? Commodities, of course. So as we see this inflationary period, we know that if we're going to invest in something, we want to invest in something that we know is going to go up in price, not down. Stocks more than likely are going to go down. So that one we got to be careful with. Crypto, we got to be really careful, although we're going to talk about it. But commodities, more than likely, in an inflationary period, will go up in price. So that sounds like a win. So, but what are the problems? And I'm actually going to call them risks. Okay. What are the risks of commodities? Number one, again, liquidity. Okay. You could have a problem with liquidity. Number two, they're very volatile. Okay. Number three, there's a lot of risk in it. There's risk for risk. They fluctuate a lot. They're kind of, they're like crypto. They're always going up, always going down. So like, what price do you buy it at? What price do you sell it at? Do I just hold it? Do I just, it's a difficult one. It's not my favorite. But what I did here is when I was putting this list together, I was thinking, what are the most common things that you would hear in the news or by Googling, or the most common things that you would hear if you read a book? These are the most common hedges against inflation. But none of these are really something that I think, maybe 1 or 5% of you would participate in those two that I just said, but the majority of you would be like, yeah, I just really don't know how to do that. I don't really know how to buy commodities. I don't really want to store gold in the garage or my closet. So like, there's got to be another way. One of my favorites is something that a lot of you are involved in, okay? And that is real estate. Well, we got to be very careful about this one. Number one, I'll be the first to tell you that me and my wife have done lots of real estate. I've done wholesale, I've done wholesales, I've done flips, lots of rentals. I've kind of done a little bit of all of it, and I hate it. I can't lie. I really can't. Today, like we were trying to turn the gas on at one of the houses that we just sold. The utility company goes out. They need an 8-hour window. Okay, already pissed off. You're going to make somebody wait there for 8 hours. So it's $100 bill coming out of my pocket to pay someone to sit there and play on their phone for 8 hours. Luckily, somebody went there early. As luck would have it, the utility company plugs their little pressure meter in and says, oh, you got a leak. Sorry. Yeah, see ya. Call us back when you fix this. So then you try to get a plumber. Good luck getting a plumber to do a leak like that. Plumbers are so busy, they don't want to. So, I'm just fed up with real estate. There's always a problem, but I will then say real estate is a really great thing to have in an inflationary period. Look around, folks. If you own real estate now, what has happened to the price of your real estate with this inflation? It's gone up tremendously, hasn't it? If any of you are owning rentals, how many of you have rented a unit in the last, let's just say 4 months? Have any of you rented a unit? Let me hear it. Did anyone rent a unit? Yeah. Okay. So Nancy did. Nancy, did you get more money than you were getting before on that unit you rented? Okay. Christy said hundreds. Mark said yes. All right. So let me just ask all of you, when you're renting these units in the last couple of months, are you asking for more money in rent? And if you're not, I have to ask why. But the answer is yes, absolutely. Rents are up 10% nationwide, more in most places. I mean, like if you were charging somebody $750 in rent, you're probably now charging $900, maybe even $1,000. And you know what? You got a long line of people that want to rent. Every single week, I get some random person emailing me, hey, do you have any units for rent? I don't. I'm fully occupied. And that's the case with a lot of people. Most of us are fully occupied. There's massive demand. There's massive demand because most people that would want to buy a house are now priced out of buying a house. Drives the price of rents up, drives the demand for rent up. So real estate is a hell of a way to not just hedge against inflation, but certainly beat it. Because if all of you are playing the real estate rental game, chances are you're definitely making a pretty good cash on cash return on your money. Some of you are making an infinite return if you've listened to our trainings on how to do that with, using different strategies and the BRRRR strategy to make an infinite return on your money. But you're all doing pretty well, and I can tell. So first off, that's good if you own real estate. But what about those of you that don't own real estate yet? Great. Does this still make sense to beat inflation? It does, because rentals are going to do exactly what we said. But here's the thing you need to be aware of. If you're buying real estate today, which it's very difficult to find deals in this market. If something goes on the MLS, it's going to have 10 to 100 offers, especially if it goes up cheap. And they're doing that now. They're underpricing houses and driving crazy bidding wars. It's just like going to the auction, right? But if you're buying today, chances are you're overpaying for the property. And I don't mean to say that. You might think, oh, I'm not overpaying. It's right in line with comps. Comps are overpriced right now. You are in a speculative bubble with real estate and the stock market. Make no two ways about it. These prices will not hold. Oh, but there's so much demand. So many people want to buy houses. Look at the list. There's not enough houses for the people that want to buy them. True, true, and true. But take away their income, take away the gains from their stock market, take away the gains in their 401k, take away the gains in their crypto. How many buyers are out there clamoring to buy your house with 50 offers on it? Not many, if any. Okay. So you have to understand, if you're buying real estate today, you are overpaying for the property 9 times out of 10. So you're already buying it at the highest point. So the rental really has to make sense. The numbers on the rental have to make sense. Your cap rate better look pretty damn good. If you're buying it today and you're like, well, it covers its expenses, and I think I'm just buying it because I think the price of it's going to go up. Unless you live in Florida, maybe Texas, maybe Salt Lake City, you're kidding yourself. You're literally lying to yourself. Look at yourself in the mirror and say, you liar. If you are, there's no way. There's no way the prices of real estate right now are going to keep going up through what's about to happen. It's not going to happen. You might have a year, maybe another 2 years of increasing prices, but after that, game over. So if you're buying real estate, just be aware that when you want to sell it, if it's in the next 5, maybe 10 years, there's a very high probability you will not get more than what you paid for it. But if you just buy it to hold it, you know, like, I have no intentions on selling, I'm just cash flowing this. It's giddy up and go, man. Get on the horse and get going. Because the rental in real estate, almost always, if you know anything about how it works, will beat inflation. Fair enough. Anyone have any comments on real estate? And also, you know, Christy just made a comment, and I don't know what she was referring to, but this is an important thing. A great way to buy real estate today, a great way, is most of you, you know, that own houses, not all of you own houses. And listen, I think renting a house right now is probably smarter than owning right now. I truly do. Now that's almost, what's that word when someone says something, but they're not doing what they say? Hypocritical. That's hypocritical because I just bought a new house, but I also have a 16-month daughter that sometimes you have to put family in front of logic or things that you believe. So I did just buy a new house, but I did not overpay for it. I'll be the first to say I actually did really well, but that's rare. But I think renting a house right now makes a ton of sense, because I think in 2 to 3 years from now, you're going to be able to buy a house 20 to 30% off. That's just my opinion. So why buy now when you can rent? But the problem is, a lot of people are being priced out of rentals. So we got a big problem here with real estate, which means that problem can be solved by you by owning real estate. So anyway, I beat that one up quite a bit, but any comments on that? But what I was getting at is with what Christy said, all of you have a house. I got down a rabbit hole. Steven, you got to stop me when I do those rabbit hole things. So if you own a house, you have equity in your house. No way you don't. Go to your bank, get a home equity line of credit on that house. And that's money that you literally did not have yesterday. And it's money that literally has been sitting lazy on your couch, doing absolutely nothing while you're out working. So get a home equity line and go out there and try to find yourself a good rental that makes sense by the numbers. That would be a good play. Your lazy money in your house will not be there forever. Think back to 2006 and 2007. Everybody thought, oh my God, my house is just going to keep going up. People were literally living off of the equity in their homes. Truthfully, California, people were living on the equity in their homes. And then it all went away. Great recession kicked in and all that equity gone. Banks pulling lines of credit, freezing lines of credit, not happening anymore. You don't have that money. It's a gift today. That equity in your house is a gift. But send a thank you letter to DC, thanking them for driving so much inflation, driving the price of real estate up, that I just got X amount of equity out of my house and I'm not going to give it to you. That's what you send them a letter. Don't put your name on it, because then they'll send the auditors out to audit you as to why you're not going to give them that money. But use the equity in your house. Use it to buy real estate. Use it to buy things that are going to get you ahead and get you ready for what's coming. Make sense? If you're not using the equity in your house, I just can't understand why you wouldn't right now. There's too much of it. The rates are too cheap to use the money. And there's nothing, you literally, except for maybe a couple points on your credit score, there is absolutely zero negative part of you like getting into the equity in your house. If you don't use it, you don't pay for it, you have it. And then if an opportunity comes, you can deploy that money and make more. All right, let's keep moving, because now we're going to get into some fun stuff. All right, so the next thing I'm going to talk about is something that you hear me talk about a lot. You'll hear Harry Dent talk about it a lot, but it would be U.S. Treasury bonds. But not just any U.S. Treasury bond. I'm talking 30 and 40 year, or sorry, 20 and 30. My mistake. I don't know where the 40 came from. I think I'm thinking mortgages. 20 and 30 year U.S. Treasury bonds. Now, as soon as I say that, most of you would look at that and you would say, Wait a second. If I buy a 20-year US Treasury bond, do I have to hold that thing 20 years? Absolutely not. You could buy it today and sell it tomorrow. Heck, you can even buy 20+ year US Treasury bonds with an ETF called TLT. This is what I buy. I just sold it because it was going to go down. So I sold it and then I'll buy it back a little bit, but not going to get into that. That'll give you good exposure to 20 and 30-year US Treasury bonds. But also, some of you may have heard of TIPS. Okay. I don't mean the tips that you give your waiter. I mean Treasury inflation protected securities. It's another bond issued by the US government that is pretty darn good to keep pace with inflation. So as inflation goes up, TIPS will typically trend with inflation. They're kind of boring, but the cool thing about buying US bonds, okay, bonds from the US government, is the liquidity factor. It's the most liquid investment you'll ever buy. If you don't want them, somebody will always buy them, because this is the conservative. I mean, US Treasury bonds are backed by the US government. The full-fledged credit and power of the US government is backing it. They've never defaulted on a bond ever. The problem is, you go to your financial advisor and you say, hey, I was just reading or just listening to this thing on this training, and they said we should be buying 20 and 30-year US Treasury bonds. Your advisor is going to tell you, that's idiotic. I don't know what happened, but most advisors have forgotten what they learned in the Series 7 stockbroker book. Me and Stephen were talking about this last night. So this is a bit of a repeat if you were on last night's training, but I just want you to understand why you would do this. Okay. This is an X with a circle through it. So this is going to represent the yield you earn. You guys remember that? I before E always. And I started doing it wrong. So the yield on these right now is about 1.8 to 2.3%. And you're probably thinking, well, that sucks, Chris. You just said inflation is 4 to 6 or 7 or 8 or 9 or 10%. Why would I put my money in something that's only going to pay me 1.8? And your advisor will say the same thing. Your advisor will say, who told you that? Those things only pay 1.8%. You're going to lose money investing in that. Or are you? Because here's the thing you don't understand, and this is what your advisor should understand that they seem to have forgotten, is it's called the inverse relationship to interest rates. So right now, inflation, which we're talking about, is going up. So we're going to draw a little green line, and that line represents inflation. Okay. It's on the move up. What does the US government or the Federal Reserve typically do to combat inflation? Go back to the 1970s and 80s. What did they do? We already talked about it. They raised interest rates. What have they been doing since last year when COVID hit? Raising interest rates. Slowly, very slowly, but they went from close to zero now to 2.3%. So even though you'd think, oh, well, they haven't raised interest rates, they keep saying they're not going to raise them. They have. They're just very slowly. So interest rates are going up. Now, there's a lot more underlying factors, but I just want you to understand, if inflation goes up, interest rates are going to go up. It's always how it's going to work. It's just basic economics. You probably remember it from 5th or 6th grade. They taught this. If interest rates go up, it has an inverse relationship to the price of the US Treasury bonds. The longer the duration, the bigger the impact on the price is. So if you had 30-year Treasury bonds, when interest rates go up, the price of the bond goes down. So pull up 20 and 30-year Treasury bonds and look at a year's price. Okay, look at the price over the year. It's gone down, straight down. Look at TLT, that ETF I talked about, the price has gone down. What does Warren Buffett say to do to make money in investing? What's rule here? Hold on. I want to see who can get this. Ron LeGrand, information on internet marketing and boot camp. Now I'm going to make this a little tougher. I want to know the 2 things that Warren Buffett says that I repeat often. What are they? Okay. So Brad and Jameson got it, but you guys got to give me the rest of it. Okay. So first thing that they do, which is already on the screen, they buy low, sell high, and don't lose money. So neither one of you got that, but I just gave that to you. What else do I always say? Another thing that Warren Buffett says a lot for this packet, this information packet training. Okay, hold, don't sell. Come on, guys and gals. Like, oh, here we go. Someone's getting close. Michael, you got to get the right terminology there. It's close, but you got to finish it. This is a big gift, and it's going to cost probably $5 for me to ship it to you. Come on, what do we got? If poor people knew what the rich do, they wouldn't be poor. That is right. But that's not what I'm looking for. Blood in the water. But Sean, what there's more to the blood in the water thing. Come on, let's hear it. I need them both. So I need one email. If poor people would just start doing what rich people do. Yes, that's what he says, but that's not what I'm looking for. I gave you one. Hold on. What? Be greedy when others are fearful, and fearful for when others are greedy. All right. So Ethan, all I want you to do, Ethan, because I'm going to give it to you anyway. I want you to tell me the other thing that I already repeated. So Warren Buffett says, be greedy when others are fearful and be fearful when others are greedy. Okay. People right now are greedy, so you should be fearful. But what's the second piece to that I said earlier? And I'll just give it to you. Buy low, sell high, and don't lose money. So congratulations, Ethan. You got that one. All right. So let's come back over here. So if the price of something is going down because of the impacts of what's going on in the economy, i.e. inflation and interest rates, if the price of this is going down, what should we be doing based on what Warren Buffett says? Should we be buying when the price goes down? Yeah, we want to buy as this goes down. So if the price of treasury bonds are going down, we want to start buying them. They're pretty low right now. I just looked this morning. I mean, I'd preferably like to buy that TLT at about 140 to 142, but it's a good price right now. Not a bad investment, not a bad way, but now you're still caught up with this because your advisor says, yeah, but it only makes 1.8 to 2.3. Why would I buy that? Let's flip the switch here. So I'm going to change the color and we're going to flip this around. And now we're going to look at why. Eventually, what's going to happen to inflation? Whoops, what's here? My lines are getting dirty here. So we'll get rid of that. Sorry, getting sloppy. So eventually this is going to change, right? Eventually, what's going to happen to the market? It's going to collapse, right? What is the first thing that happens when the market goes down? I say this all the time. Interest rates go down. The market goes down like it did last year. Just think last year, COVID. When the market tanked, what was the first thing you saw in the news? The government lowered interest rates. Then they lowered interest rates again. They just got that lever. I always say this. I repeat myself a lot, folks, not because I don't think that you know what I'm talking about, because I'm trying to get you to remember. And that's why I give stuff away to try to see if you can recite to me what it is I always repeat over and over and over again. So buy low. Okay. That's what we're going to do. Secondarily, what is the benefit in the end? When things change, the Fed pulls the interest rate lever. When they pull the interest rate lever, what happens to the price of bonds? Now, this you might not know. This is advisor stuff, but your advisor should certainly know this. Stephen knows this, right? Stephen, what happens when the Fed pulls interest rates? What happens to bonds? Price goes up. Always, every time, the price will go up on bonds. If you own 20-year treasury bonds, and let's just use this. Let's say interest rates go from 2% to 1% or lower.
And Teddy just brought this up, actually. This fits in perfectly. So he said, why did TLT? So TLT is just a way to buy treasury bonds, 20-year treasuries. It's a ticker symbol. It's an easy way to trade them. So he said, why did TLT go down? The market is also down, and all my ETFs also went down, which is different than the last 8 months. But Teddy, what are rates doing right now? Rates, they're increasing rates right now, right?
That's why.
So that is the exact correlation of what you're seeing with TLT going down.
Yeah, and you also sometimes have to remember, like, what you're seeing in the news is old news, okay? The market's already built that in. So a lot of times, like, you'll see something happen and then you'll hear about it in the news and you won't be able to figure it out. It's because the markets are always ahead of you. The information that they're using to base the pricing and everything, it's way ahead. So when you hear or see something happen, it's already built into the market price. So that's why the price is going down. Interest rates are going up. Even though you watch the news and they keep telling you, oh, we're not going to raise interest rates. They are raising interest rates. They have been. And they're going to have to, because if inflation starts going out of control, which indeed it will, it already is, but it's not going to slow down until deflation kicks in, then that's going to happen. So if you were to go from 2 to 1, how much would you make on a 20 or 30-year treasury bond? Well, here, I'm going to give you a range. It's a mathematical equation, but 20 to 40%. The price of your bond, risk-free, would go up 20 to 40%. You'll hear Harry Dent talk about this. It is literally not speculation. It is a mathematical calculation. So how many of you would be okay if you bought something today and then a couple of years, the market tanks and everybody else is losing money and you look at your account and it's up 30%? Would you be okay with that? Risk-free. Risk-free. You got all the liquidity in the world. If you needed that money to buy a car, to fix your roof, sell it. Everybody will buy it. You guys would be okay with that, right? That's the thing. This is U.S. Treasury bonds. Why is your advisor not telling you about this? In most of your 401ks, you should have a government bond fund. It used to be in every 401k. Now, who knows? Now they got these fancy retirement freedom bullshit funds that have 2+% fees, but nobody reads the prospectus. Oh, they don't even mail them to you anymore. Now you just get an email and you're like, 1,002 pages. Yep, I'm not going to read that. Like, that's where all the goodies are. That's where it tells you how much money you're paying in fees. The easier that Wall Street makes it for you or makes it seem to you, the more expensive it is and the more money they're making. Oh, this freedom fund, it's great. I'm retiring in 2020. I'm retiring in 2040. So I'm going to buy a 2040 retirement fund or freedom fund. And this thing's just going to self-adjust and get more conservative when I get there. Wow, that's easy. I don't have to do a damn thing. Okay. This is just like the government. Government says you don't have to do a damn thing and we'll pay you. Is that free? Absolutely not. Well, it's not free over there either. You think it is. They made it super easy, but because they made it easy, the fees are higher. They're the most expensive funds there are. Just trying to get you to see what's really going on out there. Okay, let's keep going here. You guys got U.S. Treasury bonds and you got tips. So those are some good tips. All right, next. This is where we get into the stuff that me and Steven really love. Because this is the stuff you're not going to see in Google. You're not going to see it in Investopedia. You're not going to hear anyone else really talking about it unless you dive a couple layers deep. So now, how do we beat inflation? Super freaking easy to beat inflation doing what we do. Okay, I don't know what number am I on here? 5? We'll just call it 5. Doesn't really matter. The number one way that we will beat inflation is through private lending. Or I'm going to tie this into moving your money. So I want to ask you a question. Where do you lose to inflation? You lose when your money's sitting there earning less than what is going on, what things are going up in price. That's how you lose to inflation. But if your money's always in motion, every 6 months or every year, you're moving it through something and moving it into something and out of something, how can you lose money? You've seen me do the presentation with the bank, right? The circle where, you deposit money, the money gets lent out on a mortgage, then it gets lent out on a car, then a home remodel loan, then credit cards. You've seen that, right? And you see how the interest rate, the spread keeps going up and up and up. It's the bank moving money. Banks don't worry about inflation because their money's in motion. So as one cycle goes or one loan pays back, they're just increasing the rate with inflation, or they're just adjusting it. You can't. So my favorite thing is private lending. Okay. On here, I wrote down private secured loans. So we have a whole program called Private Money Club. It's designed exactly for this. Think of eHarmony for dating. Okay. If you guys have ever used eHarmony, I have too. Okay. 2 profiles that come together, a couple messages back and forth. You follow a simple template, boom. You're on the date and you're like, no, that's not going to work out. Or you're like, this could work, right? We did the same thing for private lending. We just said, hey, there's people that have money that want to make more money. Lots of them. And there's a lot of people out there that need money to make more money. So we just said, why don't we just create a community where people that have money and people that need money are together? We'll put the education in the middle so that everybody understands how to do this the proper way. And then we'll put templates and processes in place so that you don't make mistakes. Do X, Y, and Z. You can still make mistakes because you cannot follow the GPS we give you, but you get the point. So we did that. It makes it super easy. It's how I lend my money. It's how Steven lends his money. Heck, we're lending an awful lot of money, but we're not lending any money because we don't get in the middle of your deal. You pay us once per year and you go have fun, man. Go date, go lend money or borrow money. Private lending. How much is our private loans going for today? I'm going to say 8 to 12. But Steven, how much did you saw a couple deals get done in Private Money Club. How much were those deals?
Yeah, there's some people on here right now. They're funding at 15%.
Freaking 15%. Now, hold on a second. If inflation right now is pegged at 4%, you beating inflation at 15? Yep. You beating inflation at 12? Yep. You beating inflation at 8? Yep. Oh, but Chris, there's a lot of risk with that. There is risk, but secured means that there is some tangible asset securing the loan. How about a house? How many of you did you guys hear that I said real estate, renting it could be a pretty good way to beat inflation? So if you're doing this and you own nothing, but you control everything because you are in a first secured position on the loan, own nothing, but control everything, you're getting paid every month in a rate of anywhere between 8 and 15%, which is beating inflation. And then eventually that loan pays off. Brent Kessler, you all know him, Hannah's on here. He just did a loan through Private Money Club to one of our lenders on there. Our lender paid him 12%. And I just got word this morning that loan is closing tomorrow. Literally, they sold the house. His money's been to work for maybe 1 or 2 months. So he only got 2 interest payments at 12% on what he lent. But you know what? That's still better than that money sitting in his bank account. So he'll get that money back in a week or so when the title company mails it to him. And what's he going to do? He's immediately going to move that money again. He's going to go into another deal. And he's going to just keep doing that. It's not hard, folks. It's different than what you're used to because you've been lied to your whole life. It's the only reason it's different. Who's been doing this the whole time? The banks and the wealthy. This is all they freaking do. The banks just loan money. They take your money and they loan it out. You can do the same thing. So private lending is absolutely a great way to beat inflation. Any questions on private lending? Yeah, I love it. Everybody, listen, like Jameson and everybody saying, keep it moving, keep it moving. That's exactly it. You lend it, it comes back, you just move it again. But maybe you don't do a private loan, maybe you do something else. Like, it's so freaking cool that you can move your money. But what's another way to move money? Everybody right now wants to talk about crypto. Bitcoin, Ethereum. I'm not going to get into the shit coins, but you get it. Like, everybody's talking about this. So how do we use crypto to beat inflation? Well, carefully is the word. So if crypto it trades like this, it's kind of like this. Steven, I don't know if you want to share your screen and show them what crypto actually looks like or what Bitcoin looks like, but it kind of looks like that. Up, down, up, down. It's one of the most volatile investments out there. But the cool part about crypto is it's very predictable lately. And let me define crypto. Bitcoin is what I'm talking about. So we all know, like right now, I think Bitcoin's trending at about $42,000, give or take. Let's see. Where are you at today?
Crypto came down a little. I think it's below 42 right now.
Yeah, I don't know. I'm just trying to get it here. 41,000. So, wow, awesome. Buy some more. So it's at 41,000. Here's what I will tell you. If any of you just know how to look at a chart, very simple. What I want you to do is I want you to literally look at a chart of crypto, of Bitcoin specifically, and it'll kind of look like this. But then what I want you to do is I want you to connect the dots. I want you to draw a line at, like, when you see where it hits 1, 2, 3 times.
There's a 6 month, Chris.
What?
There's a 6 month right here. Oh.
Right. So he's going to put it on the screen, 6 month. Okay. So 6 months, if we were, yeah. So let's see, it's kind of hard because see, this one's kind of got weird numbers, but if we were to draw lines, I'll tell you what it'll say. It'll basically show you 40,000 and 50,000. Okay. We'd probably tighten that thing up, but 40 and 50, that chart would be a good one to look at. And we know that it's been trending. Yes, did it break a little bit through? But yes, but it came back down. But all I'm saying to you is if you want to beat inflation, how I've been doing, and this won't be forever, but right now it's working quite well. I buy at 40. So yesterday I bought, what did I buy? I think $4,000 worth of Bitcoin. And then every week I'm buying 200 of Bitcoin and 200 of Ethereum. I'm dollar cost averaging in. So I'm always buying on the cycle. But I bought $4,000 at right around 40, 41, I think is where I got in. When it hits 50 or 49, I will sell. And if it goes past 50, I won't even look at it. I won't even care. And I'll wait for it to come back down because China bans it, or the US might say, oh, we're going to ban crypto. We're going to ban Bitcoin. Great. It'll come back down to 40. Hell, maybe I'll even get 30 and I'll buy it again. And I'll just keep buying it and selling it, buying it and selling it, and buying it and selling, because I'm too nervous. Like, I'm a nervous Nelly right now because I don't know when this whole thing's going to go down. And I definitely know that crypto is directly correlated or tied to the performance of the stock market. We did this on What the F Happened this morning, where we showed Bitcoin and what did we do? Dow or S&P?
The Dow.
Dow. So we looked at two charts and literally it was like, wait, am I looking at the exact same damn thing here outside of Bitcoin being more volatile? So can you beat inflation just doing this little strategy? Yeah. Join us this weekend for the 3-day training, which we got a special offer for everybody on here today. And you're going to learn from Spencer, one of the top, in my opinion, crypto guys out there. He's one of the top because he's so hyper focused on how it works, why it's going where it's going, and how to trade it. He might not love this strategy because he buys it and holds it, but I love this strategy because it works. So do you guys like that? Does that make sense to you? It's not hard. You pull up your Coinbase or wherever you're trading, you look, oh, it's at 40. Great. I'll buy a little bit. I'll put $500 in. I'll put $100 in. Okay. And then you look at it another day, I don't know, on lunch break, and oh, wow, it's at 50. Sell. You literally had to spend 30 seconds the one time to click buy, and you had to spend 30 seconds the next time to click sell when it hit 50. It's freaking easy. Not hard at all. So that's a good way to do it, crypto. Okay. But you got to be careful because it's very, very risky. And I always like to say I saved the best for last, but you all know where I'm going next, right? For the last book, for the very last inflation hedge. This is a William Bronchick, Bronchick, Price Reduced Foreclosures, the ultimate guide to short sales and foreclosures investing. How many of you think this will be important coming up here pretty soon? How many of you think short sale and foreclosure investing might be something you want to learn a little bit about. So I'm going to give this one away. And what I want to know is what would be the last inflation hedge or the last inflation beat, what can we use to beat inflation? And what would be that thing that we're going to use? Can somebody tell me what that is? First person gets this. Okay, Jim Collins. See, I keep the questions really, really simple. So Jim Collins, make sure we get your address. You can email it to Steven. You get that. Of course, the infinite banking concept is where I'm going. The infinite banking concept is a banking strategy. How many of you think that the infinite banking concept is those stupid whole life policies? How many of you think that? So just be honest with yourself. How many of you think infinite banking concept is a product? Does anyone? Okay, no, thought they were the same. Okay, yes, sir. All right, I just want to be clear. The infinite banking concept, which was pioneered by a gentleman by the name of a late Nelson Nash, genius man. You should watch his YouTube videos. He wrote the book, Becoming Your Own Banker. All of you, that's a must read, kind of like Rich Dad, Poor Dad. The infinite banking concept is a process. It is a process of mimicking what the banks do in your life, taking back the banking functions in your family and in your life. That process, yes, does need a machine to move the money through, because every banking system needs some type of a machine to move the money through. And what Nelson found and what the banks figured out years ago, and the Rockefellers, the Rothschilds, the JPs, the Morgans, the Ray Krocs, the Walt Disneys, what they all figured out is the best machine or vehicle to run our money through is none other than a specially designed and engineered whole life. But a lot of people, the talking heads or the IUL guys that think they know everything, they think that the whole life is infinite banking. They think that there's no differentiation between the whole life and IBC, and they're totally wrong. The infinite banking concept is just a process that we add the machine to, because it is the only machine that can do what it does, and that is give you uninterrupted compound interest. I'm not here to do an IBC presentation, but I want you to understand that this very well might be, and some would argue with me, and I'm happy to argue it, but this very well might be one of the biggest secrets of the wealthy, bar none. This and 1041 tax reporting and learning how to do trusts and foundations, those two things single-handedly, I would say would be number one and number two, arguably, depending on the person, they'd flip-flop, the two biggest secrets that the wealthy know that you don't. No ifs, ands, or buts about it. The wealthy know a lot of things that you don't, but those two rank the highest, because the infinite banking concept shows you how to actually take back all of the banking functions in your life. In other words, the infinite banking concept can show you how to build wealth through your debts and expenses. The only thing you've done with your debts and expenses is give money to somebody else. The infinite banking concept, very simply and very calculated, shows you how to take that money back. Doesn't happen overnight. That's the problem. That's the biggest problem with the infinite banking concept. It's the biggest problem with building wealth, is everybody's in a freaking hurry right now. You keep hearing the word FOMO, fear of missing out. That's because everybody's in a damn hurry to get wealthy. Stop being in a hurry, because building wealth, making money, that's the easy part. All of you are good at that. There's not one person on here in the 139 people that is that good at making money. Steven is very good at making money. Everybody's good at making money. All of you in your right mind and your right ways are good at making money. Do you know what most people suck at? Maybe me and Steven, not so much. Maybe Hannah, not so much. Keeping it. Show me one person that's really good at making money and really good at keeping it. And then I'll tell you, you found yourself somebody that figured out some things. It's a problem. Until you start trading with rules, you haven't figured out how to keep money. Until you start learning how to hedge your investment positions, you haven't learned how to keep money. Until you learn the different things I showed you with US Treasuries, you haven't learned how to keep your money. You might know how to make it. You might know how to grow it in the stock market or in crypto, but please show me how you're going to keep it if you don't have a plan. You know, what did Mike Tyson say? Joseph, what did Mike Tyson say? Everybody's got a plan until they get punched in the face. That's all of you. And I don't mean to pick on you, but I am here to wake you up. I'm literally here to say, hey, here you go. I've got a red pill and I got a blue pill. Which one do you want? You've seen the Matrix. What one? Pick. You got to make a decision here. You're either going to get on the inside or you're going to always be on the outside. The outside, the cool part about that is it's easy. You just listen to what everybody else tells you. You just follow the sheep. Like it's a piece of cake. You don't have to do anything. So that's cool. And if you want to be on the outside, I don't know why you're here, but that's fine. Like to each their own. But if you want to be on the inside, you know what sucks about it? It's hard. It takes time. It's a marathon. It's not easy. It's a grind. You got to constantly keep working at it. You got to learn new things. You got to apply those new things you learn, which is what my job and Stephen's job and this entire team's job is, to help people solve their money problems by putting them back in control of their money. So the most important thing that you can learn is the infinite banking concept, but the infinite banking concept works the best with a privatized banking policy. That is the machine. And can anyone tell me what the privatized banking policy is? None other than those terrible, awful, horrific life insurance policies called whole life. That's exactly what it is. But it is not the whole life that you buy from your broke-ass brother-in-law. It is not the whole life that you buy from the insurance store. It is a very specially designed and engineered whole life. It's literally built backwards, that is designed to work for banking. And you know who it benefits? You. You know who it doesn't benefit? Your agent, your financial advisor, the person selling it to you. Your advisor will not like you if you tell them to build one of these that gives you more. You say to your advisor or your insurance agent, you say, hey, just saw this thing. I want you to build me a whole life policy, but I want you to build me a specially designed and engineered whole life policy from a mutually owned company that pays dividends. And I want that policy to give me access to 60 to 90% of my money immediately in the first 30 days. Go. Your advisor will look at you and say, oh man, I don't know who told you that, but they were lying to you. That I've heard that. That's that thing, that scam that I keep hearing about, right? They're lying to you. That you can't do that. You can't build a whole life that gives you access to 60 to 90% of your money in the first 30 days. And then you say to your advisor, well, it's not even the first 30 days. It's when my check clears. Oh, see, they're just liars. They just lie. Okay. That's what your advisor says. And number one, your advisor more than likely doesn't know how to do this. 16 years as a high level advisor. And I was never shown this, never once. I even took my managing partner out to lunch after I left that company. He said, John, I just got to ask you a question. Can I buy you lunch? Sure, Chris, it's been a long time. Let's catch up. His name is John Foster. Took him out to lunch at the brew pub, sat down. I said, John, I just want to know one thing. I was an agent for 14 years with your company. I was one of the top 3 guys. Why did you never teach me about the infinite banking concept and how to design whole lives this way? John, I could have sold so much more. I could have helped so many more people. Why didn't you show this? He knew exactly what it was. He's like, yeah, it's just like bullying. You know, when we do this for the banks don't pay commissions. They pay a very small amount. So if we taught you how to do this, most of our new agents have a hard time making it through the first year, let alone sticking around for 5 years. We lose almost everybody. So now all of a sudden I got to go to my agents. I got to say, hey, listen, guys, I'm going to teach you something special. I'm going to teach you about this infinite banking concept, where we're going to design a whole life different than the way we do for life insurance. But that way that we design it is going to give your clients 60 to 90% more cash value immediately in the first days. How many of you guys want to learn this? Everybody's hands go, oh my God, absolutely. John, show me how. And John says, well, hold on, there's a catch. We can do this and I can teach you this, but you all have to agree to something before. And I'm going to make you sign this piece of paper. If you guys want to learn this, can you agree to this? Well, it depends, but yeah, John, what is it? You got to make 60 to 90% less money. Oh, John, I can't do that, man. You got to sign this paper if you guys want to learn how to do this. I bet you 1, maybe 2 of that new org group would sign that paper because they don't want to make 60 to 90% less. Think about it. How many of you want to make 60 to 90% less money than you do today just for helping somebody have 60 to 90% more money? Do any of you want to do that? I mean, in your heart, I know you do, but how many of you could physically do that? Joseph, sucker. Not many, right? None. Jay could, okay. But most people would say, no, I couldn't. I just physically couldn't. I couldn't put a roof over my head. That's what's required. That's what we do. We've just figured out how to help thousands of people doing it. So we make a good living because we serve and help a lot of people. That's it. So the infinite banking concept paired up with that specially designed whole life is single-handedly probably one of the best ways to beat inflation. Why? Because that whole life, if you do this year only, next year, it's a different ballgame. Okay. So I want to be very clear and transparent. What I'm going to put on the board right now and what you're going to hear me say up until probably November of this year ends December 31st, 2021. But right now, the contracts for the whole life pay a guaranteed 4%. This year, 2021, this is being recorded. This will not be 2022 for anyone that starts after. But if you start this year, you're locked in at 4% guaranteed. What is inflation trending at right now? According to the Fed, 4%. So just in a guaranteed, and I forgot to mention that, this is guaranteed, just in a guaranteed interest rate that you're paid on that whole life, that would be enough to trend inflation. But we've got some things that come out. We got a cost of insurance that comes out of that. So you're really not going to net 4% in the first couple of years. But I did say building wealth is a marathon. It takes a few years. Plus, these are dividend paying insurance companies. Dividend, got it. Okay, so they pay dividends. And right now, how much are the dividends? I'd say 1.5 to 2%. So if we do 4 plus 2, we're at 6%. So if you're making 6 and inflation is 4, are you beating inflation? Yeah. So right out of the hole, this stupid, terrible whole life insurance policy is already beating inflation. But now the best part is now if we take all this, because you guys can understand that, if we say none of that matters, because what really matters is the infinite banking concept. It is what you do with the money you put in here. You put 10,000 in, we're going to take that 10,000 out. We're going to start applying it to other things in your life. We're going to pay off cars. We're going to pay off credit cards. We're going to finance things. We're going to lend money to your company. We're going to buy real estate. All those things you heard me say that beat inflation, we're just going to change where the money goes first. Okay. It's not going to go into somebody else's bank where they win. It's going to go into your bank, which is this. And then what we're going to do is we're going to immediately take that money out and do all the other things that we just talked about. Why? Well, because now you're making money twice, doing the same thing you were doing to make money once. And how many of you want to make money twice instead of once without working any harder, any longer, without taking on any risk and without giving up control of your money? This is why the wealthy use this. This is why banks own more whole life insurance than they do all the land and buildings combined. Look it up, Bank of America, look up Wells Fargo, all factual data. This is what will help you. This is what will beat inflation, or at least hedge inflation. That's my crumpled up piece of paper of the inflation beaters.